Our Steve Leisman joins us here at Post 9 with a very special guest. Steve.
Hey, Carl, thank you. Yes, we are joined, as we often are, on the first Friday after the Fed meeting by Chicago Fed President Austan Goolsbee. Austan, thanks for joining us this morning.
Yeah, great to see you again, Steve.
And it just so happens, I guess this happens around December every now and then, that we have your favorite inflation gauge out this morning. It surprised the market a little bit to the downside. What's your takeaway, Austan?
Well, it's coming into the Christmas season, and it's nice to get a number that's better than expected. And I've been feeling that we're still on path to get to 2%, and at least for this new month, you don't want to make too much out of any one month, but I'm hopeful that this suggests that the couple of months of firming were more of a bump than a change in path.
Yeah, I asked the Fed chairman about this earlier this week in D.C., whether or not he was looking through it. You had maybe some hurricane effects in there, some other things. Were you among the committee members, Austan, who raised his or her outlook for inflation next year?
For next year, as you know, the dot plots are anonymous, but I have been feeling like there's a little more uncertainty, there's a little more noise, and so I raised a bit what do you want to call it, the shallowness. I made the rate path a little more shallow in 2025, but I've been saying that the overall thread is that inflation is way down. I believe we're on path to 2%. And over the next 12 to 18 months, rates can still go down a fair amount. And whether that happens 3 months earlier or 3 months later, I don't think is the most material thing. The thing that's material is we've gotten inflation down. We need to keep making some progress. We've gotten unemployment to a kind of a stable, full employment basis. We want to keep that stabilized. And the way to do that is to have the rates come down to something like neutral.
The chairman on Wednesday, Austan, said the following things, not together, but separately. He said, the Fed is significantly less restrictive than it had been, but is still meaningfully restrictive. Where do you come in on both of those sides? Where do you put us between being still restrictive? Okay, give us an idea.
I agree with both of those.
You think we're still meaningfully restrictive, putting downward pressure on inflation, and yet we're significantly less restrictive than we were, which means you sort of still think we're far from the neutral rate.
Yeah, all three of those. I don't think those are contradictory in any way. We had raised rates 500 basis points in a year. If you looked at just the real federal funds rate, it was the highest in decades. We're now down 100. We've cut 100 basis points, and so we're significantly less restrictive than we were. But if you just take as an approximation, where is the longer run neutral, something like the median of what comes out of the dot plots on the committee, they think that the ultimate rate is around 3% with inflation of 2%, a real rate of 1%. We're still above that, so I still think it's meaningfully restrictive, and that's why I say over the next 12 to 18 months, if conditions keep on the way that they have over the last 18 months, I think rates come down a fair bit more.